You are listening to Keystone's Stock Talk Show, episode 318. Great to chat with you again. This week, I'm going to kick off the show with a quick look at Warren Buffett's life advice from his Thanksgiving letter to shareholders. I will also answer a viewer question on Neo Performance Materials, symbol NEO on the TSX, a leader in the innovation and manufacturing of rare earth and rare metal-based functional materials. The stock has had a great year, but pulled back after its Q3 numbers. I will take a look at why and answer if the pullback offers an entry point. Brennan has put together an investor spotlight on Greg Abel, the Canadian that is taking over from Warren Buffett at the helm of Berkshire Hathaway. And Brett answers several viewer questions on serial software acquirer Constellation Software Inc., symbol CSU on the TSX, which has had a tremendous track record of compounding capital long-term, but has seen its share price drop nearly 25% year to date and around 30% from its year highs. Brett lets you know why and whether this drop has this high quality business on sale. All right, gentlemen, let's get to the show. I'm going to welcome my co-hosts, the Killer Bees, Brett and Brennan. How are you guys doing? Are you guys excited for our upcoming webinars? This week on the 27th, it is Thursday. We're going to talk markets, going to talk what stocks to buy for an uncertain 2026 AI mega caps. You're going to do a bank review with gold surging. Brennan's going to look at 4 drillers. So a number of things we're going to put into this webinar. Really excited and show you just simply how to build that 20 to 25 stock portfolio. Any comments, Brennan? Are you pumped about your sections?
I am pumped about my sections. I was putting some time in over the weekend. So just making sure that I'm doing a good job for attendees and of course clients who will also get that, just included in their subscriptions as well in their account the following day of the event. So we'll get that up quickly in your accounts as well.
Get up to anything this weekend, anyone? Or Brett,
Not
I could
really.
let you say, are you excited, Brett? About the webinar?
I'm just... it'll be really interesting. Like you said, I'm doing the bank section, and that's had a lot of movement over the past year, really, with all the macro influences with tariffs. So it's quite interesting time for the banking sector in Canada. We've had a national, really, what I would say is become finally an actual big 6 bank. It's always been the big 5, then kind of national
big acquisition,
on its own.
Right? Relatively
big acquisition, and it's still smaller, but it's in the same ballpark now, I'd say. So I'd really say it's the big 6 now. But the valuation's really switched out the year. But also, you did not mention before, we also have on the December 2nd.
Yes, December 2nd. The first one coming up is on the 27th. We also have December 2nd. The 27th is 7 p.m. Pacific. Then the December 2nd, is 7 p.m. Eastern. So we're excited. And we were just talking pre-show about because we're going to review all the mega cap 7. We'll talk about Alphabet, Apple, Microsoft, NVIDIA, Meta. What else is on there? Tesla. I think that's about it. Tesla. Well, and we'll review all of them. We'll review all of them. Look at the valuations. We've done this a couple of times in the past webinars. Reviewed. You look to see if there's any anomalies, pricing each against each other, against the market, and then historically where they have traded as well. See if we can find some anomalies. In this spring, you saw Alphabet really be the major anomaly there in terms of it trading at a significant discount to the group. It traded at a significant discount to where it did historically and even to the market. Not many of the Magnificent 7 have traded at a discount to the market, but it traded at a discount to all of those. The share price could have been had at one point this year between 140 and 160. Today, as we're recording this, I think the share price has surged to over 350 and 317 in that range. An absolute, really a juggernaut crushing everything else in the Mag 7 over the past year, particularly in the past 6 months. And just the flip that we've seen in the market on when OpenAI came out, the massive threat that was thought to be that search was facing, and with Google and Alphabet, obviously Google facing that threat in search. But now the sentiment has shifted. Is Open AI in trouble as they're bleeding? Cash flow potentially, the promised spend there, and then is now Gemini is Google's entire ecosystem positioning it well to be a leader now, where it had been a leader for years now, but positioning it. The market is, in its view, looking at Alphabet as a potential leader going forward. I think all of those things are still up for debate. I think it's going to be it continues to be a huge market. I think there's plenty of space for many participants, but it is interesting to see how the market flips, and suddenly you go from you have to be trading at a massive, significant discount to now we're at least even to slightly going into a premium on Alphabet. And that happened in 6 months. So anybody who tells you the markets are perfectly efficient at all times, I mean, it's just silly. There's a company that had literally thousands of analysts looking at it on a daily basis. And somebody got it wrong, likely in March, April, or in that range. And now you're seeing it today. Maybe they have it wrong today too, but it certainly, has had a flip in terms of sentiment, and the share price has risen. We're happy to say it has been a focus buy in our VIP portfolio for a significant amount of time, and it has really powered returns in that portfolio this year. Again, it's up over 100% in the past year for a company of that size. It's great to see for our clients, at least.
Yeah, you were also on Michael Campbell's Money Talks over the
I
weekend
forgot
as well.
about that. It's been busy. I'm telling you, it's busy times here. And I did Michael Campbell's radio show over this weekend. We talked about Hammond Power. We talked about Argon. We talked about Group Dynamite, and I made a couple of recommendations that our clients already know about and wrote about for years. And we talked about the sell discipline there. When you knowing when to sell, looking at the fundamentals of the business. It's not necessarily a stock's gone up 300% or 2,000%, and now you know how to sell. Or if I wish it was as simple as stock trades at 10 times PE buy, stock trades at 30 times sell. It's not that easy. There's a science to investing and an art, and we kind of went through those, all the emotions and all the numbers that you look at when you're looking at a stock, and when to make a sell, or if you want to sell a half position. So we went through that, and I think it was a good appearance. Always enjoyed talking with Michael and his group there, and we look forward to our webinars, but I also look forward to going to the World Outlook. And we talked about that going there. I'll be there again this year doing a small cap portfolio in early February. We'll see a number of clients, a number of new investors there again this year. It'd be great. Thanks for reminding me.
You're welcome.
That was this weekend. All right. Anything else you guys want? There's a poll. I'm sure there's a poll, right? Yes.
Yeah,
what do we got?
We got, so it is actually ties into what we were talking about, is how much more runway do you think AI stocks have to go? So yes. 20% of our viewers say there's a bubble and it is ready to pop. 32% said they expect strong returns for the next year. 9% say they expect the run to continue for 3 years. And 39% say AI is just getting started and will run for many years to come. If you took the top two, like the near term and the far two, it's a 50-50 split, which really shows that the market really isn't decided in one way. Sometimes when we do these polls, we do get a dominant answer, and that's just not the case here. We have quite a dispersion.
Yeah, I mean, it's the amount of money that is promised to spend. Even if you just look at, say, OpenAI's promised spend, it's in the range of 1.4 trillion over a 10-year period. Again, that's for a company, I think, that is projected to do 20 billion in revenue and lose money this year, and likely lose money for the foreseeable future. So there's going to have to be a ton of funding coming from other sources. It's certainly not going to come from OpenAI's cash flow over the next several years. It has to come from a ton of other sources, and whether that all comes to fruition, and whether or not some of the big players are willing to foot the bill to finance a business that still is not producing cash flow remains to be seen. And that is part of the argument that, it looks to have flipped in the market, where you have Alphabet with a hoard of cash, them owning, 100% of Gemini versus, like, say, Microsoft owning, I think it's 27% of OpenAI. And, them being able to kind of monetize these AI solutions a little, or their power in AI a little bit easier than some other players. Certainly, Microsoft has the ability to monetize as well. But, there are some other players that, I would question whether there's a lot of companies that have propped up that have AI in their name that I would be very worried about. And that's where I see more of the bubble than the large names. But there are some large names out there that I don't know if the business model makes sense right now. We're going to see. It is in the early innings. That's not to say that too much, many funding promises haven't already been made and just won't be able to be cashed on over the long term. So we shall see. We tend to, as human beings, whatever it is, build too much, too fast, and then and it corrects. And there'll probably be a cycle like that in the overall, this broad AI spend at some point. And then there'll be some amazing opportunities to pick off some businesses that come on sale that probably shouldn't. So we'll always be watching that as well.
Yeah, and we've been seeing more and more debt come onto the market now too for these AI companies. I think CoreWeave was one of the concerns there over the past couple months. And it's not going to be probably your Apples or your Microsofts or Googles, that they won't blow up. They'll still be fine at the end of the day. It's just whether or not they're going to obliterate their cash flows for a few years and you do or do not get the return. That's the question when it comes to them. But then if you're really talking about a bubble, it really has to be debt fueled at the end of the day. And we are starting to see more and more debt enter the market. So if you do start to see they are doing I forget what it was, the creative financing, which once you start hearing creative and finance together, it starts
circular financing,
and all that, however you want to explain it, it does start to give an idea of where this money is coming from and is it sustainable. And right now, these deals, they don't seem that sustainable to me. So cash flow has to come in, real cash flows from end customers have to come in eventually. And right now, your $20 OpenAI subscription or ChatGPT subscription is not enough to prop up these companies. It's a tiny fraction of really what they need to have end consumer spend. So are we going to see right now the consumer's really winning because it's discounted by your speculative investors, your private investors? And are we going to see that flip? Are we going to see your ChatGPT go from $20 a month to $400? That's what I'll be watching for. Are we going to see ads coming in more and more? Where are we going to see that shift? Because it's going to have to happen, or at least attempt to happen at some point here.
Yeah, I mean, if you're going to have to monetize, or else, right now it's being financed by fairy dust money that came in. That's just, if it's not driven by cash flow valuations at some point, it stops, it dries up, and then it can abruptly, and that's where you can really, get into trouble. Or if these companies keep getting debt, and then, you realize that the cash flow coming in, or even the projected cash flow in the future, cannot support the debt that has come in, or the financing, and that's when the issues come in. I'd rather stay cautious. And again, people have been asking us, really, how do we play AI for several years, and we've been saying companies like Microsoft and Alphabet, and they've done tremendously well, and you have more of a margin of safety. So that's what we're continuing to harp on. That it sounds like, well, you don't have a ton of ideas there. Well, no, we've looked at a ton of companies, and you can't buy a company, even if it has revenues growing from 10 million to 900 million. But if it's losing 200 million on a quarterly basis, like, the margin of safety in this business is not in your favor. And the more companies you put with that profile in your portfolio, the more you're going to lose over the long term. And we'll just talk about this at the upcoming webinar.
Yeah.
All right.
One thing that I'd say as well, just on that, is, we recently, not too long ago, spoke with a Canadian small cap. And one of our questions to management, to the CEO, was just, are you guys implementing AI? Where do you see this in your business? And he kind of laughed. And, was like, everyone's saying AI now. A few years ago, it was just called big data. So it's just interesting to see that transition as well in someone like that. Open Door, that's another company which I recently looked at. The company has been burning cash flow for 10 years. It was a high flyer in 2021, 2022. As far as I'm concerned, the business model of buying and selling houses through its platform, isn't sustainable, or it hasn't been. There's no substance to the business model there. And of course, now management's coming out and saying Open Door 2.0, where the company is now planning on using AI to make its buying and selling of homes more efficient. Again, it's just interesting what we're seeing. A lot of these companies that are floundering, potentially hopping on the bandwagon, kind of like me with the Oilers.
Exactly like you with the Oilers. Awesome. Okay, so we've done the poll. We're gonna look at Buffett's quotes, right? That's what we should do next. Let's do that. I'm gonna share my screen. I've got them up here, and you guys can comment on them as I'm reading them. I'm sure you'll have tons of comments, right?
Awesome.
Loads.
Of course.
Loads. All right, these are from Warren Buffett's direct quotes from his 2025 Thanksgiving message, direct quotes from Buffett's message to shareholders. These are more life advice quotes, more than just portfolio advice. But the first quote he had is, decide what you'd like your obituary to say and live the life to deserve it. I think it's a pretty good quote. If Brennan, have you written your own obituary?
Not yet.
It sounds morbid. I can see you doing it though for some reason.
Probably,
this is what I'm
yeah.
going to put on there.
Probably.
No, I was going to say I know you have a book that you want to put together. You could put that on here.
I do.
But let's not say that now. We won't get into that. So let's move on to the next quote. Greatness does not come about through accumulating great amounts of money, great amounts of publicity, or great power in government. When you help someone in any of thousands of ways, you help the world. So
yeah, I mean, I just think that at the end of the day, that just shows, like materialism. And again, I've been saying this so many times when it comes to Warren Buffett, is like this lack of ego, or dissolving the ego. Again, like money, materialistic, like prestige and fame, these are all kind of empty pursuits at the end of the day, where that's not really what's going to bring you happiness.
yeah. I mean, and they could say, oh, it's easy for Warren to say that he has all the money in the world, but he's literally gifting away his basically the majority of his fortune to charities. So
yeah.
I mean, walking the walk there. He says kindness is costless, but also priceless. I think my daughter is incredibly kind, which I am proud of, and she reminds me that I need to be kinder all the time. So it's not to her, but other probably. Yeah. Anyways, so yeah, it is true, and I think we could all use a little more kindness. Whether you are religious or not, it's hard to beat the golden rule as a guide to behavior. So he doesn't care if you're religious or not, but yeah, the golden rule is a good one to live by. Brennan, do you do that?
True that. No, I totally agree. And again, I'm just throwing, this has become a philosophy podcast, but I think that a lot of religions point in the same direction. But again, we kind of, humans throw their own things on them. And yeah, I think that underlying all religions are, that kind of golden rule. And yeah, it's true.
Yeah. Now, I think this next one kind of sticks with me, but it says, keep in mind that the cleaning lady is as much a human being as the chairman. So I would say I agree with this a ton. I really do try to live by that. I remember a moment almost like 20 years ago, I think I've told the guys before, that kind of reinforced this idea. I won't go through the entire story there, but it's a long story. But we had a photographer come in to our office for do a photo, for a column that was being written on Keystone. This was like 20 years ago. the gentleman, he was a great guy. I remember him staying with us for about 2 to 3 hours. I know we were extremely busy at that time too, but this was after the shoot, and he wanted to talk stocks, and he said how much he appreciated myself just talking with him for 2-3 hours. He said he was going to introduce me to some people who could really, really help our business, change your life, blah, 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 long term. So, like, you hear this, you're going to hear this, like, people, if you're just starting in business or anything like that, or just in life generally, you're going to hear that from millions of people. Most of the time, there is little follow up, but this time it turned out that his wife was the head of a certain department at a huge daily newspaper when newspapers were a thing back then, the Vancouver province. And within a few weeks, I was writing a syndicated financial column that went then to go across Canada. And I went on to author that for over 10 years. And, it helped the profile of the business immensely. So, it was this guy, we could have just said, get the hell out of our office, right? But he was interested in the business, which is great, and he was interested in stocks. I spent all that time with him, and it certainly paid off. Didn't do it because I thought something was going to come out of it. Did it because he's a nice guy and wanted to just treat him the way you would if he walked in and you thought he was a $1 billion investor or something like that. It was just and he ended up really helping us out, which is great.
Yeah, exactly. And if I could add another Marcus Aurelius quote that kind of goes along this lines. Well, again, it's this stoicism. You guys can laugh all you want, but Marcus Aurelius says Alexander the Great and his mule driver both died, and the same thing happened to both. They're both absorbed into life essentially. So again, it's just you have the greatest man at the time and his mule driver, they're the same. They're both, humans underlying, part of the world, part of nature.
Yeah.
Sorry, I'll stop with my stoicism quotes.
No, so the next quote was, yes, even the jerks, it's never too late to change. And so that's another thing my daughter says to me all the time. So it's good.
I don't have a quote for this one.
Yeah. I know. Okay. I thought your girlfriend would say that to you at some point, but no. Choose your heroes very carefully, then emulate them for sure. It's awesome. That's why I emulate Superman all the time. I don't know.
With the flying? Is that what it is?
Yeah. I've tried to fly. It just keeps landing on the ground. It's not good.
I mean, I think all of us could say that, Warren Buffett is kind of our hero.
Yeah, there you go. So, I mean, he's saying this. Why not? I mean, you could do far worse than emulating. Mr. Buffett. Now, you will never be perfect, but you can always be better. And trying to be better all the time. I would use that in the company all the time, trying to get better at everything. I mean, we're always faced with new things. AI has come to the forefront. So we're looking at better ways to use that. There's so many different things that you want to be better at. So if you stop being curious, stop trying to be better at things, you're certainly going to fall behind, and you have to keep trying to be better. And Warren did that all throughout his career, learning new things, but he also stuck to a core confidence, which is kind of admirable as well. Not if he didn't understand, or he didn't, it wasn't within his circle of core confidence, he's just like, I'm out. We did talk last week that they really just the first time Berkshire added to a real tech. I mean, Apple is a tech company as well for sure, but they are some say consumer products company, but there is a walled garden of tech around all those consumer products. But they made a big investment in Alphabet, and we're just saying how much the share price has gone up just since Warren has dipped his toe into that stock. It's a toe dipping for their portfolio, but it's a $4-point-something billion investment. All right. So any further comments on that? Are we good?
Well, actually, Marcus Aurelius also said, just kidding. Oh, I'm joking.
Actually, I should go back to sharing my screen because I'm going to talk now about NEO, right?
Yes.
Yes, you are.
This week, I'm going to answer a viewer question on NEO Performance Materials, symbol NEO on the TSX, trades at around 1669, $694 million market cap, pays about a 2.5% dividend. They have three business segments intersecting the engineering, processing, and manufacturing of advanced RE, critical minerals, and magnets. They are global leaders in each area given their 30 plus years of operating history and have 9 manufacturing facilities in China, Germany, Estonia, the UK, Canada, Thailand, plus a dedicated R&D facility in Singapore. I'll give you a rare earth 101 to start here. Rare earths are a group of 17 metallic elements. They're most simply broken down by their atomic weights and then referred to as light or heavy rare earths, LRE, light rare earths, or HRE, or heavy rare earths. Rare earths are used in magnets, phosphors, metal alloys and batteries, auto catalysts, fluid cracking catalysts, glass and ceramic additives, and glass polishing powders, among many other things. Now, let's look at NEO's share price this year. Tremendous performance. While slumping post Q3, as we'll talk about in a second, the performance has been great. Year to date, up 110%. But all time, if we go back to when it IPO'd right at the end of 2027 in December, the shares have not performed well, down approximately 5% in nearly 9 years. They've certainly been volatile over that period. Let's take a quick look at those Q3 numbers, which halted the upward momentum in the stock. Revenues were an increase of around 10% to 122.2 million. Adjusted EBITDA, however, was 19.2 million, about a 2% decrease from Q3 2024. EPS, a significant increase at 20 cents from adjusted EPS of around 3 cents in the same period last year. A note here, the reported Q3 2023 EPS actually beat consensus estimate of around 15 cents. So they beat the consensus, but the market did not like the drop in adjusted EBITDA. Cash flow for the 9-month, cash was actually used in operating activities for the 9 months was about 25.4 million. That was primarily driven by a $12.5 million settlement of a European patent claim. They had higher receivables and an increase in strategic inventory in the quarter. Let's look at the segmented performance here. MagnaQuench is where we saw the strongest growth, increased sales by 20.4% to 54.9 million. The driver here was record bonded magnet volumes, which were up 21% year over year. Adjusted EBITDA increased in this segment by 26.7% to 8.1 million. Highlight here, this represented MagnaQuench's strongest quarterly adjusted EBITDA performance in over 3 years. That was driven by robust volume growth. The chemical oxide showed a significant profit turnaround. Revenues increased by just 3.3%, but adjusted EBITDA soared 213% in the quarter. The driver here was a massive increase. That massive increase reflected solid performance attributed to higher rare earth prices. That's where you can see some significant fluctuation in this company's profitability and a successful transformation of the business and continued operational discipline. We'll talk about that transformation in our conclusion. And in the rare metals segment, normalized following record prices. They had record prices in the quarter last year. There was a slight increase here, about 2%, but adjusted EBITDA was down significantly, almost 30% in this area of the business. The driver here was a decline. It was expected, but it primarily reflected the normalization of hafnium prices, a rare metal, rare earth, following record highs achieved in the prior year period, Q3 of 2024. The overall consolidated result was a slight decrease in adjusted EBITDA. That was due to like we said, the significant decline in rare metals segment, offset by those gains in the MagnaQuench and chemical and oxide segments of the business. So the Q3 results highlighted 2 major project milestones: the new European sintered magnet facility and the heavy rare earth separation line. Let's look first at the new NEO's Performance Materials European Sintered Magnet Facility. It's a significant project in Estonia aimed at establishing a resilient and independent European supply chain for high-performance rare earth magnets. The project status right now, it's open and operational. The facility held its grand opening ceremony in September of 2025, the end of the reporting quarter. The production status, the facility is already producing and shipping qualification magnet samples to customers. So just starting with the first samples shipped in April of 2025. Target markets here, the magnets are crucial for electric or EVs, traction motors, aligning NEOs with the EU's Critical Raw Material Act and local supply chain initiatives. The initial capacity that is in phase 1A is it's projected to produce around 2,000 metric tons per year of sintered magnet block, enough for approximately 1 to 1.5 million EV traction motors annually. Expansion plans, this would be phase 1B. The plans are in place to scale to capacity of over 5,000 metric tons per year to meet demand from customers. The major contracts that are in place, the facility has secured contracts already, including a significant supply agreement with a leading European Tier 1 supplier of EV traction motors, representing about 35% of its phase 1 capacity. NEO has also extended its strategic partnership with Bosch for high-performance magnets. Let's look at the funding and the location. It is strategically located near NEO's rare earth separation facility in their existing facility in Estonia, and supported by the EU, an EU grant, a Just Transition Fund, and a $50 million US credit facility from Export Development Canada, or EDC. Let's look at that heavy rare earth separation line in Estonia, in another area of Estonia. The project is aimed at providing an independent Western source for the most crucial and difficult to source elements. The status here, it's nearing completion. NEO is in the process of installing the heavy rare earth separation pilot line. Targeted timeline, commissioning and the start of the small scale separation is expected early into 2026. What is the significance of this? The line extension of the existing rare earth separation infrastructure in Estonia allows them to process the full suite of rare earths, including heavy earths or HREs like dysprosium and terbium, which are essential for performance magnets used in EVs and defense. So this marked the Q3, these milestones, the opening of the European magnetic facility, transitioning this product from construction risk to an operating asset, while the HRE separation line progression is progressing well towards full commissioning. So these are milestones that the company is hitting on. Let's look at the guidance here. You can see they raised this. Well, this was raised they reported that it was raised, but it was raised earlier this year, previously in August, up to a range of 67 million to 61 million, up from 64 to 68 million, driven by a strong third quarter performance. Let's look at the company's balance sheet. They have maintained a strategic cash position while incurring debt, primarily related to funding its European expansion projects, which we talked about above. NEO's net debt position is conservative with a relatively high cash balance that's used to fund major CapEx projects. Year to date, those have been 8.4 million, and they covered that 12.5 million patent claim settlement earlier this year. Let's look at the valuation. So overall, the balance sheet is fairly solid, conservative, but the valuations right now, the PE on an adjusted basis is slightly over 100. EV to adjusted EBITDA is 8.4, a little more reasonable. The PE, there's expected to be a significant increase in EPS or adjusted EPS in 2026. So clocking in right now just under 30. And then the EV to adjusted EBITDA for 2026 is just under 8. So our conclusion here, the business intersects multiple areas of rare earth element and related magnet and chemical compound nationalization, and potentially has decades plus of growth ahead. NEO has been slowly moving up the value chain in recent years and starting to reap the benefits. They are global leaders in permanent magnet manufacturing, which is a complex task, and automotive emissions catalysts that have years of growth ahead, and have improved operations historically from the volatile RE business lines to more consistent historical earnings, and have fluctuated significantly with price input and end input. That's historically over time. They've had very high levels of earnings fluctuation with the prices of their inputs and end products. The valuations here, like we saw on a PE basis on current earnings, they're high. If the company can deliver on the growth that analysts see for this business over the next, say, 1 to 2 years, we'd say more 2 to 3 years out, the valuations are more reasonable. This is certainly a company that we monitor closely, and we'll be speaking with management in the near future. There is our disclosures, and I am done.
Yeah, I mean, nice to see that they're actually fulfilling, some of the additional capacity that they're bringing on as well. Because, that's always the thing with a company that's bringing on capacity. Can they fulfill it? A company that can't all of a sudden fulfill the capacity can get into trouble by, all of a sudden they're bringing on a new facility, higher costs, and whatnot. But it's good to see.
For sure. And they're at 30%. They got to keep fulfilling it, obviously, right? They got to go through that, but they're starting at a level that at least gives you some optimism that they may be able to move forward and get up to the 50 plus, 75% plus. That they probably need to really start to be profitable. Again, they still have to do it. So we'll continue to watch the company de-risk itself, and maybe there'll be an opportunity long-term in this business. Certainly, if they can get rid of some of the volatility that has been in that business. You've had a company that has tremendous quarter, then loses money, tremendous quarter, then loses money. Smoothing that out over time in this segment would make them a viable investment option over the long term. That's what we're looking for. We'll continue to monitor.
Yeah. And I was just going to add, they've just been in the right place at the right time over the past 7-8 months, really, since the April, just the geopolitical shift. And you can see that right in the stock prices, even though the Estonia plan was in place for 3-4 years, and they've been building out for the past 2.
Yeah.
The share price practically didn't move during that entire time. And the second the geopolitical risk and the supply chain disruption came into picture, stock price just surged. And that really just shows, even though they were executing, it just wasn't really what the market was thinking about with the supply chain shifts. And that was what they were wanting to do, was shift out of China. And just opportunity timing wise, it seems to worked out quite well for them.
And I'm sure they know the situation on the ground there, but they had moved ahead of, the tariff situations and all that, which is, it's good to see that they were proactively moving ahead. But then like you said, it aligned with all the geopolitical activity that's gone on, and where else can the world get supplies of, rare earths and processing and find good, solid companies to process. So it is an option right now. Again, it is expensive based on earnings. If they can execute on the growth, it is something that we would look at more closely. All right, Brennan, you're going to look at Berkshire Hathaway and Greg, the Canadian, Abel, taking over Abel. What are we going to say?
That is correct.
Pronounce.
Okay, so thanks, Ryan. And just considering you went over Warren Buffett's last Berkshire letter and recent 20F filing, I thought that I would complement the segment by doing an investor spotlight on Greg Abel, Warren Buffett's successor as Berkshire's CEO. Now, one of the things that I find most interesting about Greg is that he's from Edmonton. So in this section, I just kind of want to go over his path toward becoming CEO of one of the world's largest conglomerates, filling the shoes of one of, if not the greatest investor of all time. And I personally think he is the greatest investor of all time. I'll also just touch on some quotes from Warren on Greg, as well as Charlie on Greg. I've got one there. And then some of Greg's quotes on investing as well. So just going over a quick timeline here. Greg is 61. He was born in Edmonton and graduated from the University of Alberta in 1984 when he was 22 years old. He first joined PwC in Calgary and then moved to San Francisco and became a CPA. In 1992, Abel joined Cal Energy as a CPA, which was a geothermal producer with assets in California and the Philippines, I believe. And they were also conveniently headquartered in Omaha, Nebraska, which is obviously close to Warren. And he became the company's CEO in 1999. And Cal Energy then made the acquisition of Mid American Energy, but would continue to operate as Mid American Energy, taking its name. Now, in 2000, Berkshire Hathaway completed the acquisition of Mid American Energy and took it private. In 2008, Greg was named the CEO of Mid American Energy, which was then renamed Berkshire Hathaway Energy in 2014, or BHE. And in 2018, he was appointed vice chairman of Berkshire Hathaway's non-insurance operations. In 2021, Warren confirmed that Abel would be his future successor as CEO of Berkshire. And in 2025, Warren made a surprise announcement that Greg would be his successor as CEO at year end going into 2026. Apparently, only Warren's kids knew that he was going to be making his retirement announcement. Now, under Abel's leadership, he really turned a small geothermal business into, Berkshire Hathaway Energy, what we know it today. And he led the strategic acquisitions of Pacific Corp in 2006 and NV Energy in 2013. He also has a renewable focus, heavily invested in wind and solar, making BHE a leader in renewable energy, or in the renewable energy transition. And today, BHE now contributes roughly 10% of Berkshire's total earnings. And the reason I really want to go into this is that Warren got to see Greg's execution skills as he led the energy development at Berkshire. And of course, Greg got to learn from Warren and Charlie along the way. And that's why, moving on to this next slide here, I wanted to start off with this quote. As Warren has worked with Abel for over 30 years and got to see his execution skills. He says he will make those decisions on capital allocation, I think, very much in the same framework as I would make them. We have laid out that framework now for 30 years. And it's important, of course, to find competent stewards of capital. We have a company under coverage, which has been one of our best returns over the last decade, and have an update coming out for clients soon. Now, management has recently enacted this, a new growth strategy, and there remains execution risk. But over the past decade, we have been able to see this company execute before our eyes, and we've been able to judge their business acumen along the way. So again, we will be putting out an update report on the name shortly, but it just shows, how important it is to find, good stewards of capital who have the same kind of alignment as you do. Now, he also says, Greg understands capital allocation as well as I do. That's lucky for us. I think the prospects of Berkshire will be better under Greg's management than mine. He's an outstanding manager, and he is the hardest worker in the room. And Charlie also said, Charlie Munger, he says, Greg is an absolute meritocracy man, and he's the hardest worker I've ever met. Now on to some Greg quotes. He says, we always want to be disciplined about the price we pay. Just because it's a good asset doesn't mean it's worth an infinite amount of money. And just this weekend, I was actually talking to Ryan about Zcore ZDC on the TSX Venture. I think we should probably do a segment again on it. And generally, we view this company as a good company, far better than half or, even 3/4 of what is on the Canadian exchanges. And the stock has had a tremendous run over the last few years, but the business is just insanely priced at over 40 times cash flow, over 370 times trailing earnings, and 10 times sales right now. That's a tech multiple for a capital intensive business that has basically doubled its share count over the last 3 years and levered up to maintain growth. Again, a good company, but just because it's a good asset doesn't mean it's worth an infinite amount of money. And in my opinion, it is a bit pricey right now. Maybe that's a segment we can do in the coming weeks just to go over a little bit more. He also says there's always a temptation to do something, but you have to have the discipline to wait for the right pitch. Now, sometimes the best thing to do is to sit on your hands. We can still find value in the markets. They are generally pricey right now. But when the opportunity arises, we will recommend a business. There's a great company that services the oil and gas sector right now, but we just want a larger margin of safety on this business, a better valuation before we want to make a recommendation to our clients. And having that discipline to wait for the right opportunity is a good way to preserve capital and get those asymmetric investment opportunities to the upside rather than the downside. He says, cash is very important to us, and retaining that strong cash position gives us the flexibility to move quickly when the right opportunities arise. And this is probably one of my favorite quotes. Warren talks about the curiosity being important as you go through things. That would be my style, to have questions and comments around their business, their frameworks. And, I have a quote that has actually been written on my whiteboard behind me for the last seven years. You can't see it because it's up there. But it says, curiosity is greater than a basic degree. And while I do think that obviously a degree is important for a framework of investing, the person who is curious enough to thoroughly understand an investment opportunity has an edge, and those who are not curious will not put in the work. I also think that a lot of the times when we get into these management interviews with companies, sometimes the simplest questions are the best questions of just really understanding, the how a business works. What are the key performance indicators? So, looking ahead, as the designated CEO, Abel faces the monumental task of succeeding a legend. His challenges, of course, include maintaining the unique decentralized culture that attracts business owners, navigating the energy transition with BHE's vast utility portfolio, and of course, just looking forward, investors do view him as a stabilizer who will preserve the company's moat and culture, of course. As of May 2025, Greg Abel currently owns $175 million in Berkshire Hathaway stock. And last but not least, of course, Ryan's favorite thing, an Oilers fan is taking his favorite investor's job.
Gross. I hate him already.
Yeah, I thought you'd like that one.
Yeah,
to be honest,
great.
I was looking online to see if he's actually an Oilers fan. I couldn't see anything
We're not sure.
concrete.
I don't think he'd be that stupid. Let's be honest. No, I mean, no. Honestly, he'd be smarter to pick the Oilers than the Canucks. So there, yeah. I didn't pick him. I was born here. Can't help it. Yes. All right. No, it's a great summary, and I mean, the proof will be in the pudding. We'll revisit 10 years from now, 15 years from now, but it does seem to be a reasonable choice, and I'm sure Warren did pick well. But you do wonder, even when Warren steps away or when he eventually passes, is there a reaction in the stock? Because, he's an absolute legend, and because of the results he's delivered over the long term. So interesting. It will be when he's 95, so it's amazing. He's been at the helm for that long. It's great.
Yes.
It's impressive. Now, all right, we're going to look at another, this is another situation where you have somebody stepping down, longtime founder of a company, Canadian, a legendary investor really in the Canadian markets that stepped down, but Constellation Software is the company he run, and CSU and the TSX. We've got a number of questions on this with the company coming down in share price after really, no stock does this over time, but it's done this. And then you saw a drop in the share price, and Brett's going to let you know why.
Yeah, so we got a submission from James, but we've got, I don't know how many questions on Constellation, especially recently with the share price decline. It's just been tons and tons of them, but I will say James did submit one. And yeah, like Ryan was saying, Mark Leonard, some people actually compare him to Buffett, ironically, the Canadian Buffett for tech. So this is the Buffett show today. But yeah, no, it's really been a big change over the past few months. The stock's declined quite a bit, so we'll get into why it's declined and go from there. So Constellation Software is a Canadian acquirer manager of vertical market software businesses. The company acquires cash flowing companies and then subsequently uses that cash flow to acquire more businesses. The company has more than 125 different verticals and over 100 companies. The company has 6 operating groups: Valeris, Harris, Jonas, Vela, Perseus, and Topicus. But it should also be noted that Topicus and Lumine, which they operate under Valeris, also have publicly traded shares under TOI and LMNN as they were spun out in the past 5 years, both of them. But Constellation remains a holder of the shares. So the stock has really had just a phenomenal performance, to say the least, since its IPO in 2006, with over an 18,000%, and that's not including the dividend reinvestments or anything like that, just purely share price returns. So it's no surprise that many people are holders of the company, as it's massive in size for the Canadian market. As you can see there at the end of the chart, it's came down over the past 6 months, declining over 30% in the past 6 months. From the peak, it's about 35%. So why has this happened? As you can see here, just really since August, that you can see that first dip, real big dip there, being that their Q2 earnings. But there was a couple reasons for the pullback. First, the one which I want to go into was the stepping down of president and founder Mark Leonard due to health reasons. So unexpected. He will remain as a director on the board. Mark Miller, different Mark Miller, the current CEO, will succeed Leonard. I would not be overly concerned in this development like I have in some people, as Mark Leonard, legendary investor figure, and I think that's where some of the concerns, same sort of thing in the Buffett, where you have that pinnacle name stepping down. But given the the company is autonomous within its business groups, and it's not a top-down, it's quite spread out, quite autonomous is the word which I will keep repeating here probably. So there's strength behind the company, really just in the structure it is, not to need reliance on a single person. The real strength, I would say, is the company's long-term capital deployment strength, meeting their criteria, which I have up there. If you go to their website, looks like it's early 2000s, but they have their clear acquisition lined out right on their website. So while the stock did fall 6% after the announcement, following the announcement, I would say that business's day-to-day just isn't going to really change. The company did have a conference following the leadership change with the new president, Mark Miller, stating, "I really think it's business as usual. I just continue to push ahead with our existing strategy." And just for context, Miller has been with Constellation for over 30 years, so it's not exactly a new face. You don't have an outside entity coming in and you're expecting some massive shakeup. So I'd expect ultimately a very similar overall philosophy and not a dramatic change. So even though it is a short-term negative, but I don't think it's going to be a really business disruptor. It's not really inherent to a 30% drop. But what's been being picked up more and more, because that was only, of course, 6% of the 30-some-odd percent, wherever you want to measure it from, is the AI fear in the market. The fear of AI-based solutions just eating away at the underlying software's market share, regardless of what vertical it is really what is driving, I would say, the larger concern. However, on the other hand, the company can actually integrate AI into its own solutions as it sees fit. So you have these two sides to the AI introduction to the business, whether it's the negative being disruptive or a positive when them integrating themselves. Management is very conscious of this potential risk. They actually held a conference call, which almost never did. They didn't do quarterly conference calls, an outlier in the space, but they held one for AI. So they are very conscious of it. And the real question which they're pondering at this time is, and I think much of the market is, whether the AI is a 10x productivity improvement or is it a 10%, because you have very two different outcomes. If it's a 10%, you'll have some minor shifts here, but if it's a 10x change in productivity, you can actually have significant disruption. And that's what the share price is saying, is they're expecting a bit of a disruption. Whether that's 30%, that's the question for speculation. The company's MD&A has also just added a new risk factor, saying many of our businesses use or plan to use artificial intelligence in their operations. Challenges with incorporating and managing its use may result in competitive harm or adversely affect the result of our businesses. So risk very apparent. The management, this isn't a surprise, but given the market's really unease around AI, it is a risk. Will it lower the barriers to entry for new competitors? Likely, but to what degree? But at the same time, the company can actually benefit from its own use of AI. So I'd really say this is not a clear win or loss. It's just a change, and it's something which over time we're going to need to see how the company adapts. Does it adapt well? Is it going to adapt quick enough? Are customers going to still want to purchase their verticals for whatever the software in whatever the respective vertical is? Further, the company has not seen any shifts in acquisition valuation, which this is, I think, is a key piece of information, because if AI really starts to bite, that would likely appear. You would see a shift where the AI companies, they start to see or AI software starts to really see these inflated valuations across the board, and the ones which are getting pushed out, you see valuations decline. So that will be something to watch, any commentary around that. And we can see a quick look into the financials. This is in US dollars. Revenue growth of 16% to 2.9 billion, of which 5% was organic, or 3% after foreign exchange impact. You can see the bottom table, which I have up on the screen, does not have significant organic growth. It is a growth by acquisition story. That's nothing new. That is the business. But it does show just how much of their growth is powered by acquisitions. You are not looking for that organic growth story. The company still has great free cash flow per share growth over time, and that's free cash flow available to shareholders because they do account for the non-controlling interest. While the quarterly figures are lumpy with seasonality, the company is still seeing good growth. Quarterly FCF grew by 46% to $24.96 a share. But if you look at the trailing 12 months, clear out some of that noise, it was only an increase of 32.2%. Still great, just not as great. Not going to downplay that. It's still great growth. So despite the fears in the market contraction, the fundamental growth of the company on a trailing basis has still been strong. Now, I will note here, GAAP EPS is just really, in my opinion, not a great judge of the company's operating performance because of amortization, which is one of the few times which I will really say GAAP isn't great, because it's not really representing the economic reality of the company, as amortization of the intangible assets which they are acquiring has a degree of subjectivity for the life of the asset. So while you do want to watch GAAP, it's not as there are some subjectivity in it, where most of the time there is less than the adjusted or alternative figures. Cash flow is a great figure for Constellation. One of the big factors for Constellation is actually the share count has effectively stayed the same since the IPO. They have not been issuing shares ever. They've only taken mild amounts of debt. You can see net debt and lease of 2.37 billion. That's relatively small compared to the market cap. But the shares have just stayed the same at 21.2 million for 18 years. That is just very strange to see. And it is actually quite great to see, especially for a company this size. You aren't seeing that dilution like you do in many other places. But shifting to valuations, we can see the premium valuation has declined. Currently, the shares are around 29.2 times free cash flow. Compared to the post Q2 drop, it was still at 40.7. And then just halfway through the year, relatively arbitrary date, June 30th, it was at 48.8 times. This is a clear re-rating in the company, if you want to consider it that way, or it's, if you're looking at it as like a DCF or something, it's a higher discount rate. The market is pricing in higher risk within the company, or lower growth, or a combination. So that really will wrap this up. The stock is really, in my opinion, more interesting than what it has previously been, as it's always had a high valuation for many, many years, and now it's come down quite a bit. Despite that really dampening view, the financials so far continue to be strong. The sudden stepping down of Mark Leonard would be more concerning if the company really didn't have a strict return on investment guidelines and relatively autonomous nature of its groups. The threat and or opportunity of AI is really yet to be seen. We are not seeing that appear in the financials yet. That is something which you will want to watch if you are considering or are invested in this company, is how do they adapt to AI? How does AI progress? Is it actually disruptive, or is it an opportunity? Because that's really the billion-dollar question at this time. But the stock price itself will likely swing quite a bit, just depending on AI sentiment over short periods of time. And I think that's what we're seeing here, is AI sentiment is seen as a threat right now. We saw that with Google. Is it going to be a threat 6 months from now? Or is it going to be an opportunity? So for now, we'll continue to monitor the stock, but if someone is willing to take a long-term view, this could be an opportunity. Just keep an eye on how AI develops as a threat or opportunity, but it's not by no means some absurd valuation like it has been previously. I would say it's a better opportunity than what there has been in recent years. And for disclosure, we do not have any investment or relationship to the company.
Yeah. Awesome. Like, and that's the thing, even in one of our chats, like this was a couple weeks ago, we had one of our clients comment, will SaaS businesses be negatively impacted by AI? And he referenced, Larry Berman was on BNN, just commenting that the downturn of Constellation Software is, related to, that paradigm. And like, it's just such a broad statement. Again, like some SaaS businesses will be able to benefit from AI. And of course, AI is going to, affect or impact plenty of businesses, including SaaS businesses as well. So like they're not exempt from, not being negatively affected by AI. But, I just think that the broad blanket across everything that, AI is going to disrupt all SaaS businesses is maybe a little out there.
Yeah, and I think the volatility, the market trying to price in some risk or benefit and really just not knowing. I mean, we went over at the start of this podcast with Alphabet. The market tried to price in risk at the start of the year. Now it's literally flipped from you could have bought it at 140 and now it's going to close at $318 today. Like that was 6 months ago. So I don't think the market has fully digested, and players have fully digested the future on what AI's impact will have on many of these companies. If it is, well, it's never business as usual. There's going to be changes. They're going to have to adapt if they can. They're trading at the low end of their 10-year. Constellation is their low end of their 10-year price to cash flow multiple. So that's usually a good time to buy a high quality business. Now, the organic growth rate is always, when I've looked at it, said, they've capital compounded tremendously well. They have increased debt to do it, but it's manageable. But, you're talking maybe 2 to 3, 4%, and if that were to slip to negative, then it's an issue. I mean, if they can still just do that minimum level, it probably makes sense, but the way they've been able to strategically acquire so successfully and compound capital. But it'd be nice if they had 10% growth rate organically. It's never going to be there, but at least keep it positive. Keep it positive, and then I think you probably look back as a significant entry point. If that turns negative and somehow AI affects them in a negative way, then that's why you've seen the share price come off. There is risk where it was just an execution story, and there wasn't this nebulous risk sitting out there for years, and now it's there, and the market's trying to deal with that, price that in. Steady hand, it may actually be a good long-term buying point right now. All right, I think that's going to end off our show. Keep your questions coming into our Your Stock, Our Take segment. We'll endeavor to answer those on a weekly basis as we did today. If you're watching this on YouTube right now, watching the show, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. We've got those webinars upcoming. It is December 2nd at 7 p.m. Eastern. And then we have the 27th coming up this week of November, the 27th of November at 7 p.m. Pacific. And if you want that full portfolio solution, we do have one. I failed to mention this. It is on the 6th, December 6th, not May 6th, like Brennan said earlier. December 6th at 11 p.m. It's 5 hours. Get that full portfolio. All right. As always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.